Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Scott, welcome back to another episode of the AWA Market Minute. Pretty exciting to have another month in the books. This particular month, we just got through Mother's Day. How was your guys'?
Wonderful. Yeah, I was able to celebrate with my mother and my wife, and hopefully they both had a great day.
Yeah. It's always fun to honor the women in our lives, and we know the sacrifices that they make so that we can have families and enjoy some of the most rewarding parts of our lives together. So, well, Scott, today we've got some topics that are hard-hitting, and it's going to be fun to cover together. We only have 30 minutes to do it, so we're going to talk about global trade tensions, market uncertainty, and then there's some significant Social Security updates and changes that will affect today's retirees or potentially affect today's retirees. So we want to make sure we cover that as well. And so let's dive in. When I say the number 0.65, what does that bring to mind? 0.65%.
So I think that is the probability that our basketball team, the Utah Jazz, wins the NBA championship next year.
Oh, that's a dagger to the heart. That's a dagger to the heart. Oh, what a brutal wake up on Monday to realize being a lifelong Jazz fan it's a life sentence.
Yes.
Yeah. For those who aren't sports fans, what Scott is referencing there is the Utah Jazz tanking last season with the hopes of collecting some really strong draft picks and being the number one losing team in the entire NBA, only got them to the 5th best draft pick. It's pretty brutal. No, 0.65% does not mean that. It is the the performance year to date for the S&P 500. And what a great number it is, right? We've gone through 5.5 months of this year, and to have the S&P finally peak itself back up into the green as of this week after a very wild ride feels pretty good. 0.65%.
0.65 has never felt so good.
Never felt so good.
Yeah.
So the question on everyone's minds, and this is a really important question, is where do we go from here?
Yeah. No, it's a great question, Paul, and I think we've been through such an experience, I think, with tariffs, and it's still, to be clear, underway. But the analogy I would use is it's almost as if we went to a physician and you go to a doctor, you haven't been feeling well, and the doctor says, hey, you have a really bad diagnosis and the outlook isn't good. It's probably terminal, and, get your affairs in order. And that's akin to what happened with the rollout of the initial tariffs.
Yeah.
It was a shock to the financial system globally. And then it's like going back to the doctor a week later and saying, hey, just kidding, the initial analysis wasn't what we thought. Yes, you still have a disease, and yes, it is still serious, but it's nowhere near what we thought it was initially. That's what happened with markets when the tariffs were walked back. And so we've seen a lot of euphoria from markets just on the idea that, hey, the super draconian tariffs aren't going to be affected, and markets have responded very positively to that. But they probably have gotten ahead of themselves. They're still failing to recognize, hey, there still is an underlying problem that we have to think through that does have implications, because all things being equal, tariff rates are still materially higher than what they've been historically, even with the reductions and the pauses. So that will have an impact on the economy in the long term. Walmart's CFO came out this morning and said tariff impacts are going to be pushing prices higher in short order. And so
Market didn't like that either.
yeah, so we've yet to see kind of the knock-on effects of these tariffs, but I think some of the black swan outlier events that people were worried about with these tariffs, I think some of those
Hopefully
have been
put that at ease.
put to bed. Yeah.
Well, and that's kind of where I wanted to frame this. I look at this and I think, okay, we can either be entering into a period of, economic growth and prosperity and opportunity that will spur on some really great periods of time in America's economy, or we could be quite literally in the eye of the storm, and this is that moment of calm before the fallout continues. When you try to perform surgery with the butcher's knife, there may be some additional pain points that you have to heal from on the back end of that, and so we don't know. We don't know which direction this is going to go, and I like the way you've framed that. It's still in that holding pattern of let's wait and see. The point I want to emphasize is, in spite of that we don't know, there are things that we can do and need to do to plan right now. And I've been reading a lot recently on a concept that researchers are referring to as the fragile decade. And for retirees, this references the 5 years leading up to your retirement and the 5 years immediately after your retirement. So that 10-year period of time is now being referred to as the fragile decade. And fragile because it will make or break the rest of your life. Beyond that point in time, the decisions that you will make during that decade will have a material impact on your peace of mind, quality of life, standard of living, ability to maintain. All of that largely will be decided on during that decade for the rest of your life.
Yeah.
And so that becomes a very fragile decade. I mean, imagine retiring December of 2024, saying, I did it. I've reached that finish line. I'm excited. And starting next month, I'm going to begin my monthly distributions out of my 401k, and I'm going to start drawing down $5,000 a month. With that, in connection to my Social Security, I should have sufficient cash flow to be able to maintain this really positive lifestyle. In fact, my wife and I have planned a trip to Hawaii the beginning of the year. Sometime in maybe April or May, we plan to get out and go see Hawaii. And then February and March hit, and all of a sudden your 401k, if not allocated properly, it's down 20%. And you're planning on drawing $5,000 per month. And now you're dollar cost averaging in reverse, you're dollar cost ravaging from your portfolio. Imagine the psychological impact that has on somebody.
Yeah, and the psychology of that whole decade is interesting, because those first 5 years of that fragile decade are the culmination, kind of end of your career, and it's an interesting time there, because on the one hand, those are peak earning years, high levels of seniority, but also a long time in the saddle. And so on the one hand, you have typically financial benefits to the degree that you haven't had before, but then also there's kind of some fatigue that sets in where you've been at it for a long time and you want to retire, but you want to do so in a prudent and careful manner. And getting that timing right is pretty important, because when you do the math, those 1 or 2 year swings, doing it prematurely versus on time, make a big difference. Because if you do it a couple years prematurely, not only do you forego 2 years of savings, you also start the clock earlier on your
distributions.
Yeah, and mathematically that makes a big difference. And when we do our forecasting with our clients, we like to be very conservative in giving them the green light and making sure there's an adequate buffer, because it's far better to work an extra year and kind of err on that side rather than do it prematurely, find out you're a little bit short, and then have to go back to work or figure out spend less or find another solution.
Yeah, and I always say the goal is to stick your landing. I mean, because you can err on the wrong side of this thing too and say, hey, I'm gonna work so long as to ensure I don't run out of money. There are two resources that you're dealt here. You have time and you've got money, and your time is a finite resource. It is diminishing, and my fear for many clients is they overwork and find themselves diminishing the resource of time, and then they find themselves into retirement with a diminished amount of time to spend and a surplus amount of money to spend it on. And when they end up passing away, their children inherit that money, and that's not a bad thing, but there were things that those clients had hoped to accomplish during those special years of retirement that they didn't have the time capacity because they diminished and utilized, exhausted that resource. So stick your landing, find the time, because you don't want to do the opposite, which is retire too early, run out of money on the back end, and end up handing out samples at Costco, right? I mean, we got to be careful on both sides of that thing. And so stick your landing. That's why we call it the fragile decade, because you introduce these concepts of sequence of return risk. I thought it was really interesting. Scott, Allianz released a survey recently, and they revealed that the majority of Americans, and they went all the way from baby boomers down to Gen Xers, down to millennials, they had 70% of Americans feared running out of money more than death. So think about the psychology of that.
Yeah.
You know, I mean, people are like, hey, this is a very real fear for us. And then a follow-up study talked about, Voya did this study that said the economic uncertainty of tariffs have significantly affected the retirement savings, and over 1/3 of respondents reported that trade policies negatively impacted the retirement funds, leading some to delay retirement or alter their investment strategies. So let's kind of use that as a launching pad into what's going on with tariff policy today.
Yeah, absolutely. So let's maybe begin, Paul, with just talking about kind of where we started this conversation, what markets have done, and we can see on this chart that you have a pretty strong start to the year, and then a fairly precipitous decline, and then when the tariff policy was rolled out on April 2nd, we see that sharp decrease, and then since then we've seen the rally that we've spoken of to get back to positive territory.
0.65.
Yeah, for the year. One thing though I think to be sensitive to is there are innumerable economic data points that we look at, and the market is not a end all be all. I think we've shared the adage before: the stock market is smart, the bond market is smarter. And in the short term, the market is a voting mechanism. In the long term, it's a weighing mechanism. And so right now we're seeing herd mentality and the behavior of the masses. We're not necessarily seeing that weighing mechanism yet as far as the full impact of tariffs. And so let's look at
explain that to us one more time. The stock market is the difference between the two, how the psychology of the difference between the two.
Yeah. So the stock market. So as far as the difference between the weighing mechanism,
correct.
Yeah. So when we talk about a voting mechanism, that's going to be reflective of current, immediate sentiment, and there's typically a lot of emotion involved with that, and crowd psychology and that sort of stuff. In the longer term, stock markets track corporate earnings. So the actual rubber meeting the road, and the money that companies are actually making. And so over the long run, the markets are going to be very reflective of what's happened in the economy. In the short term, there can be some irrationality.
Yeah, and this is why we use the phrase, time in the market is more valuable than timing the market, right?
Absolutely.
Yeah, because it tends to go back to what's actually driving the growth of the market over long periods of time, rather than the psychology that moves the market in short periods of time.
Yep. So let's look at some other kind of figures that we're looking at that I think are reflective of what we're seeing. So this chart we're looking at right here shows the value of the U.S. dollar, and we've seen the U.S. dollar fall significantly over the past 6 months, particularly over the last 6 to 8 weeks. The dollar has fallen significantly. In isolation, that's not necessarily a bad thing. The dollar has been overvalued relative to other currencies. A weaker dollar does help our exporting capability, so that's not necessarily a bad thing. The way that we got there, though, is not through negotiating better currency arrangements with other countries. It's through diminishing trust in the U.S. as a safe haven. And so we've seen U.S. assets being sold, and so that's not necessarily the best way to see the dollar go down in value, and we could see this trend continue.
Yeah, and is there any validity, Scott, to the notion that maybe other nations are even colluding to work together to see the value of the dollar being diminished, working together to say, hey, let's all go dump U.S. treasuries?
Yeah, there's no question that in the long term, other countries want to see the U.S. dollar replaced as the world's reserve currency, and some of these developments here might accelerate that. the timing on that is really difficult to say. It could be a matter of years. It could even be, decades.
Yeah.
But the trends over time have been a weakening of the U.S. dollar as the world's reserve currency, and by all indications, that trend may continue over time.
Yeah.
Yeah. So next data point we want to look at is the bond market, interest rates specifically. So this shows the 10-year Treasury rate. And the 10-year Treasury rate is probably the most widely recognized rate that's out there for just a good kind of benchmark as to where interest rates are. And we can see on this chart in the first oval where when the tariffs were announced, short-term interest rates on the 10-year rose significantly, and Treasury rates, more than the stock market, kind of forced the administration's hand to walk back the tariffs.
So, I think this is an interesting point because it's one that we didn't talk about in at least mainstream media. It was more of like, and again, we're trying to not be political here, but the spin was, hey, deals are going to get done, so we're going to walk back some tariffs. In the background, there was a lot of treasuries being dumped overnight, right?
Yeah, there was indications that U.S. treasuries were being sold en masse, and that was spooky. And by all accounts, Scott Bessent, who's the Treasury Secretary, made a meeting happen with the president to emphasize the importance of having stable financial markets, and that was, by all indications, a big part of the reversal on some of the tariffs.
And this is a case of two things can be true at once.
Yeah. Yep. Absolutely. The thing that gives me pause and gives me concern is after the reversal on the tariffs, we saw that rate go down. It started to go back up. It's still right in the neighborhood of 4.5%, and that reflects a couple things. Long-term borrowing costs are potentially going to be higher. The cost to finance the U.S. debt is higher. So that's not necessarily a good thing to see that rate continue to go upward. Last slide that I think is worth looking at. This shows U.S. GDP growth over time. And so the big movements you see in the center of the chart, that's going to be COVID. You had the huge drop with COVID at the outset, and then with the COVID recovery, you see that sharp increase. But you can see the most recent GDP data showed that GDP growth had actually contracted a little bit. And if we have 2 quarters of that, that's kind of the technical definition of a recession. I don't know that we're necessarily going to see that. Goldman Sachs and JP Morgan have both walked back some of their recession calls on the face of some of these tariff reversals.
Do you remember what the current handicap is on that? I don't recall.
So JP Morgan's, if memory serves, they've walked it to less than 50%. So they were north of 50. They've walked that back. And then I think Goldman Sachs is around 35% chance is what they're saying. So while we might not necessarily see a recession, what we may see is economic growth below our potential. So we may see kind of suboptimal GDP growth on the back of it with some of the inflation, supply chains, and issues and other things that we might see through tariff policies. So right now, the administration has articulated tariffs, deregulation, and taxes are their economic priorities. Tariffs is obviously, kind of a event in progress, as is deregulation. Taxes is kind of moving front and center to the economic discussion right now.
Yeah, and I think that segues us into some of the dialogue on Social Security because, you mentioned with the rates where they're at, one of the fears is financing U.S. debt. I think it's, $1 trillion is the cost of financing the debt.
Correct.
Yeah.
Correct.
So I mean that's
the annual cost.
The annual cost of financing our debt is $1 trillion. So if we have a $5 trillion tax revenue base, a $7 trillion annual cost to run our government to keep the lights on. So we're $2 trillion every year upside down in deficit. And $1 trillion of that is just the cost of financing the debt. That's pretty terrifying, right?
Yeah, it is, particularly, the specter of rising, interest rates, because you think about, hey, if we're issuing $2 trillion of new debt every year, that's going to be financed at whatever current rates are. And then also you have continual maturities of existing debt. So debt becomes, mature. We don't have means to pay it off, so we have to refinance that debt, and we refinance it at wherever current rates are. And so this is why interest rates and the things that drive interest rate policy, become very important.
Right. So then what we do is we look at, if this were a personal household financial situation, we say, oh, that's a lot of credit card debt, and the interest rate on that is really not ideal, and as a result, I mean, we're throwing a lot of money at something that we've already overbought. And so how do we get out of that? So we have to address the spending part of that, right? So there's a lot of reform proposals going on to try to figure out how to address the spending part of that, and a lot of emphasis on how do we go through the budget and figure out what we don't need and what we can live without. Social Security always comes up because that is one of the largest expenditures that we have as a nation. And again, this is not a political conversation. This is very much intended to just be economic conversation, so we understand kind of what's at stake here. So some of the adjustments that have gone on with Social Security, do get politicized, and so it's interesting to see how this will happen, and then they'll change it when there's backlash to say, okay, people aren't willing to stomach that change. One of those was we saw the overpayment policy reversal. So under President Biden, there was a 10% repayment policy that said, okay, if the government unintentionally overpays you on your Social Security and they catch that error, you have to pay us back 10% of that amount every Social Security check we give you until it's paid back in theory about a year. Under President Trump, that policy changed to 100%. So they said, hey, you got to give it back to us immediately. And for some people, that became onerous. If that money had been spent and they didn't have that money back in their bank, they had to turn around and figure out how to get money to pay back the government immediately. That obviously was met with some pretty significant backlash. And as a result, they've just, as of April, reversed that policy to say, okay, now only half of that money needs to get paid back. So you have basically 2 months to scrap up together the money to pay us back what you shouldn't have been paid. And it's probably nothing that really impacts our audience, but it is just something of interest. Some of the other adjustments, teachers, firefighters, those who, worked for the public sector and have a pension that didn't pay into Social Security, but maybe worked also in the private sector on the side and had jobs that paid into Social Security. They were subject to things like the windfall elimination provision or the GPO government pension offset programs that would effectively reduce or even eliminate their Social Security eligibility. And under the Social Security Fairness Act, that was reversed. So starting in 2025, most of those people are receiving either a partial or complete payment on their Social Security benefit. And we've seen that impact like real people, people that worked I had a client who was a firefighter and worked his whole career there, but also on the side had a carpet laying business and worked his whole career doing both. And he was ineligible for his full Social Security benefit, and now he's able to get a little bit of both, which has been a benefit to them as well. Scott, talk to me about what you think on the 2025 COLA, cost of living adjustment, 2.5%. Do you think that number was spot on, a little low, a little high?
I think if you were to survey, those taking Social Security, that feels very, very low,
Yeah.
right? And it's hard because inflation doesn't uniformly hit everything the same. So while certain goods might actually like go down or be relatively stable in value, things like car insurance, things like vehicles, vehicle repairs, things at the grocery store, like those have gone up significantly. The cost of eating out is staggering, So, but at any rate, I think people will feel like it's underwhelming,
Yeah.
To say the least.
Well, especially considering 2 years ago the COLA adjustment was 9.5%. So
yeah,
it's curious, right? Because we get all this economic information, and one report makes it feel like, okay, we finally got inflation in check, and we're trending in the right direction, and we're ready to drop rates. And then the next report comes out and says, never mind, there's a hot spot right over here, and the embers are still ready to burst, and we better keep rates where they are for a time. What does your gut tell you as far as what Jay Powell is going to do next on this?
Yeah, he has a very difficult job.
Yeah.
I don't think anyone's envious of Jay Powell's job right now because the Fed has a mandate, kind of a dual mandate to have full employment, and maximize that, but then also, price stability, and those are two like competing demands. And so on the one hand, Jay Powell and company definitely don't want to see inflation heat up, but they also don't want to see a recession. And with some of the tariffs going into effect, particularly if demand is high, we could see inflationary pressures, which may slow the rate of interest rate cuts. Up until recently, we were looking at potentially 4 interest rate cuts over the course of the year.
Yeah.
Markets have reversed pretty significantly on that. And so I think Jay Powell's going to be pretty reluctant and pretty slow to lower interest rates, but I think there's going to be significant pressure and jawboning from the administration to say, hey, lower rates. But I think he's going to be somewhat constrained by some of the inflationary pressures that we're going to feel.
Any validity to some of these rumors of supply chain shortages still pending?
Yeah, I think there is. If we look at, kind of, the container ship volumes and some of that data there, indications are that we had a period of time where, trade, was locking up with China at the rates that those tariffs were at. Container ships were, being empty-handed.
Yeah.
They weren't taking on cargo. And so, with the lowering of those rates and with the agreement that was announced on Monday, we'll likely see kind of some of those things being backfilled, albeit at higher costs. But we might have a kind of period of time over the next few weeks or the next month where we feel the impact of those empty cargo ships, but then we probably see them backfilled and taken care of, albeit at higher prices.
And basic economics, supply and demand teaches that there could be an inflationary pressure as a result of that.
Yeah.
Hopefully, it's a short-lived inflationary pressure, like you pointed out, but an inflationary pressure nonetheless. Rounding out some of the Social Security adjustments, two others, and I think one's somewhat interesting. They've adjusted default student loan debtors. So this has been a category where, if you have a student loan and you are receiving Social Security, and you've defaulted on that student loan, you are now added to the same category of anybody that has any kind of, like a lien or a garnishment of a legal garnishment of your Social Security. So like alimony or child support, the government would now come in and say, we will claw back your student loan if you've gone into default. I thought that was an interesting one as well. And then let's frame this correctly because I don't want to scare anybody, but there is a proposed benefit reform that's been issued by the Congressional Budget Office, and it's a significant reform, one that I just came across the wire, and I think it's probably worth discussing. But I want to frame it correctly because this is not something that is happening. It's just something that's being discussed right now. And the proposal is to adjust Social Security to be a flat monthly payment in lieu of its current earnings test. So right now we have Social Security based on how much you've contributed into the program. There's obviously significant caps based on FICA contributions, and then caps that the maximum you're eligible to get back, even with those higher contributions. But it is still at its core an earnings-based payment. And this proposal would change that to a flat payment for everyone. And the payment would be $1,660 for individuals and $2,250 for couples.
Wow.
Right?
Yeah. Yeah, and I think that speaks to a couple of things because the Social Security payouts are already very progressive in nature, right? Where those hard caps that we have, those who are earning the highest amounts of Social Security, it's not close to representative of
Right.
what they've put in, but there is some differentiation, to your point, Paul, on earnings, and this would throw that out the window and give everyone a flat payment. From my perspective, I think that's very much a non-starter with either political party. I don't see that going anywhere, but it is super insightful, I think, to see what the CBO is seeing in terms of the finances of Social Security, where they would have to cut Social Security that significantly to feel better about the long-term viability. And to be clear, I'm not concerned about the long-term viability because it's such a priority for both parties that they will find ways to maintain
Right.
Social Security. But I think that is indicative of the tight nature of the underlying finances supporting Social Security.
Absolutely. If this proposal were to go through, and I don't necessarily believe it could, but if it would, 75% of future beneficiaries would get lower benefits, and 25% would actually receive an increased benefit. I mean, think about like in terms of our clients, where it's not uncommon to see a household receiving $6,000, $7,000, $8,000 a month in Social Security benefits, and to have that cut down to $2,500 effectively, $2,250. I mean, this could amount to a 60-70% reduction for some people in Social Security benefits. That would be a very significant number. But here's the terrifying part of all of that. The math works out, to your point, Scott, where it would only create a $600 billion savings over the next decade. So, we talked about a $1 trillion or $2 trillion annual deficit, and we're saying $600 billion will be saved in 10 years over this kind of reduction. It puts things into perspective as far as, the finances.
Yeah. Yeah, and it kind of begs the question, what will Social Security look like for someone who's 50 years old right now or who's 40 years old right now? Because I think that's where we'll probably see the major reforms. I'm just kind of spitballing here, knowing kind of the way politicians operate. I don't see them being super eager to materially modify existing benefits, but it could be for those in their 40s and 50s, full retirement age gets pushed out further, or perhaps there's means testing in the future. And so I think that's the demographic that will, I think, have, a lot of the burden to bear. But I'm not super concerned for the current Social Security recipients.
Agreed.
Continuing to get what they've been getting.
No, and that's what I tell people all the time is, this current generation who's receiving the benefit, or who are just about to receive the benefit, they're too close to the finish line for them to pull the rug out from underneath them. But very likely my generation, your generation, will experience some material adjustments. And it's not very likely. It's an absolute guarantee. They have to. The program is unsustainable on its current trajectory. The math is, without feeling, the math is the math, and it's unsustainable on its current trajectory. And we know when the system goes bankrupt if they don't make changes. So there will be changes coming, but likely those changes won't be for the current fragile decade. To bring things full circle, it does underscore and emphasize the point of how critical it is that, when you're in that fragile decade, the 5 years leading up to retirement, the 5 years immediately following retirement, you need to understand, how fragile those decisions are, because things can move quickly, rapidly, things can adjust quickly. And if you don't have a plan to adjust for those things, you will be potentially in an exposed position that could materially alter the rest of your life, the ability to live and give in meaningful ways. And what better feeling is there than to take that time during that decade to say, I'm going to take all the tractors and heavy machinery and put those in the garage tucked away tight. I'm going to go and clean up all the wheat and the hay and the barley and wrap them up and store them in the silo. I'm going to go get all the tools and put them in the shed. I'm going to go get all the farm animals and put those away as well. And when I am asleep at night and the storm comes on and it is hitting hard, I am peaceful in my rest, knowing that my affairs are in order, rather than feeling the need to panic, respond to this storm, get outside and try to quickly address these problems in the moment. And that's what we try to provide people, is that peace of mind.
Yep.
So, well, with that, Scott, I think we've done a good job on our episode today. So as always, we want to have everyone make sure they retire with a plan and a direction and that guidance. And so join us again next month as we continue to talk through those things. Thanks, everybody.
Thanks.